Please stand by. We're about to begin. Good day, everyone, and welcome to the Financial Inclusion in High-Risk Area webinar. Today's call is being recorded. At this time, for opening remarks and introductions, I'll turn the conference over to Michelle Frazier. Please go ahead.
Hi, and welcome, everyone, to our webinar. I am Michelle Frazier. I am the Director of Global Content at LexisNexis Risk Solutions. And joining me today is Liat Shatrit, the Independent Consultant and Senior Advisor for Financial Integrity and MENA Programs at the Global Center on Cooperative Security. And Liat joins me today from Kenya. Welcome, Liat. Hello.
Thanks very much. Hi, Michelle. Hi, everyone. Good morning.
Good morning. So today we are going to talk about financial inclusion. And so going forward, we were looking at, Leah, I want to start out with a conversation. These webinars are really, first of all, to inform people, to set a foundation for discussion, to educate. So let's start out with a very simple, straightforward question about what is financial inclusion and exactly who are we trying to include?
Great. That's always a good place to start. So when we speak about the term financial inclusion, we're generally talking about access, providing access to financial services that can reach both members of the formal economy, so those who have access to bank accounts, savings accounts, and checking services, and so on, but also those that are members of an informal sectors. And in this regard, we think about people who are minding their herds and their goats in rural areas of a particular country. We think about people who don't necessarily have access to ATMs or a local branch of banks where it might be too dangerous to even reach a bank, or they may not even trust the banking institutions and sectors generally. And so financial inclusion in this case would refer to providing access to some sort of financial services, even to those members of the informal economy. More so, I would add that in the past few years, we've seen the term and this approach of financial inclusion and delivery of financial services to a broader group of unbanked individuals as part of a broader strategy really aimed at reducing poverty, encouraging economic development, and really as a strategy to promote stability and security. So the logic kind of goes, if people have access to savings, to the ability to develop a small business, no matter how small, no matter how large, they would be more inclined to be productive members of societies and communities. And therefore, there's a lot of discussion around financial inclusion as being relevant to security and stabilization and sort of good governance efforts, particularly as we talk about more higher risk countries or jurisdictions, or as I mentioned, sort of these rural environments.
So it's really, like as you said, about access. We want access, we want the development of business in these areas, and you're also seeing kind of two sides of the same coin. We're looking at, or many sides I should say, economic development. There's also a human rights bent to this, isn't there?
That's exactly right. So the idea of access goes well beyond kind of the ability to withdraw funding or deliver funding or send money back and forth. It's also about the idea of making sure that you can make a livelihood, that you can have access, so you can purchase things in the marketplace and that you can take care of your family. And in that sense, there is an absolute human rights element and angle to it. I would even take it to another level where when financial inclusion plans are designed to include specific sectors or for example, charities or populations, then we're really looking at trying to promote the delivery of human rights services at sort of a sectoral level. And if those particular organizations are excluded from access to financial services, then we're really not even delivering aid and human rights, which we've seen as human rights, which we've seen in some countries that have had sort of, for example, organizations that deliver aid and food and medication and so on, who had been debanked. They're unable to deliver the human security services that are needed, therefore undermining human rights. So it does get a bit more complicated, but access is absolutely the key term to be used here. Yet.
Right, so there's lots of different groups. We're talking about charity organizations that are providing services and much needed services on a large level, but then we're also talking about the development of the individual, their ability to really stand on their own, develop a business, or get money to do those day-to-day things that really in a lot of places people take for granted. One of the things that I keep hearing in this discussion so far is this idea of trust. Trust is a good thing. I mean, we understand that in terms of a financial relationship anywhere, that you're really operating on trust. This is a, transparency, understanding who I am, understanding who you are, knowing that we're both working towards this goal of profitability, and that goal should be, in a perfect world, mutual profitability. And you had mentioned at the beginning saying that there are some times that people just don't trust banks. So I'd like you to maybe talk a little bit about how trust and profits and developing those relationships is part of financial inclusion and the relationship between financial institutions and the people that we'd like them to serve in these high-risk areas.
Right. So that's absolutely right. Trust is part and parcel of kind of any service industry. I would even argue that, I need to trust my dry cleaner person when I'm bringing my best silk shirt in. I don't really own one, but should I have owned one? The idea of trust obviously permeates every single business. And when you're doing business with partners, whether it's the smallest to the biggest, you want to have trust in place. As we noted earlier, I sort of work mostly in developing countries and emerging markets across Africa and the Middle East. And one of the things that is absolutely the core fundamental principle of business, particularly as we look at sort of hawala money exchange businesses, banks who are operating at the community level, is the idea that trust is absolutely essential, because there's an ability to, and I'll just translate this to banking terms, there's a clear ability to do customer due diligence and know your customer in a way that many other sort of differently developed or more developed countries can't necessarily do. And what I mean by that is when somebody walks into a financial institution in a part of Kenya, for example, it's immediately clear which, or I'll just pick on Somalis, Kenyans, or whoever at this point, just to demonstrate the point that there's a clan, a sub-clan affiliation that goes directly with sort of clear customer due diligence, know your customer principles. And that already is a basis of sort of trust, of knowing where people are coming from. So even in countries that struggle with, for example, having a national ID system, they get away just perfectly and legally and clearly with bringing in a clan elder, for example, to vouch for their identity. And that kind of trust is a very different approach to KYC and customer due diligence than sort of relying on a government-issued ID. One of the things that I've come across repeatedly across sort of different developing countries is the mistrust and the distrust generally in financial institutions. And when you think about it, it actually makes perfect sense. For so many years, whether it be sort of central banks or other commercial banks, there's been instances during times of leading up to conflict or during conflict where people's entire life savings or entire accounts have just evaporated because they've disappeared as part of that particular conflict. And we do see that that also kind of directly taps into problems around corruption, where money just disappears from bank accounts, and people just generally don't trust the formal banking system. And it's for this reason that there are so many multiple informal channels for moving and using and depositing funds. It's in fact become so large that in many, many countries, it's actually more of the formal style of doing business. And it's actually, I would argue that the banking system is more of the informal, given how much of a particular segment of the economy they account for. So in many countries, formal banks will probably be around the 20% of economic activities, and it's really the informal activities that account for the majority of the economic activity in that particular country. And that's really sort of a broad generalization, but could be easily applied to many high-risk jurisdictions.
So definitely, I think that's a really, really good point about really what is trust in these areas. And it might not be the type of, like you said, government-issued ID. Here we have these societal trusts, like really people putting their faith in, like you said, the word of an elder or clan and saying that this is as good as a government-issued, like in the United States, driver's license or something like that. And that's really important because, and as we're going to talk about later in the webinar, this idea of local knowledge. Understanding, in any type of business relationship, you have to understand your market, right? You have to understand who you're doing business with and understand that their perceptions. So understanding how to include people into the financial system, which may seem foreign to them but normal to you, is a good pathway to communication to build that trust.
That's exactly right. And I think that the more we are able to adapt core banking principles like customer due diligence and KYC and vetting and sort of beneficial ownership of funds to high-risk jurisdictions in terms of embracing the local knowledge and integrating that into our regulatory and compliance structures, not only will we be absolutely aligning with kind of the general standards around anti-money laundering, counter-terrorist finance legislation, we'll be financially inclusive, but we'd also be paving the path for new business opportunities. And this is, I think, a direct link to profitability and to innovation. And I think that's not only just an exciting link, but it really challenges us to take these broad principles that, for example, the Financial Action Task Force, sort of the global standard-setting body on anti-money laundering and counter-terrorist financing, it really challenges us to take those kind of concepts and look at markets and innovate and say, how do we apply these kinds of standards, knowing that we would be still, for example, regulated in the U.S. or supervised in the U.K. or wherever it is that our particular bank headquarters is based, and how do we apply it and innovate? And I think that's something that is a challenge, and we'll talk more about these challenges and kind of the impacts, consequences, and so on later in the webinar. But I think for now, the bottom line on this particular topic would be that the local knowledge of fitting into a compliance program can't just be shipped off to an entirely different location that isn't aware of local culture, local communication, the local societal patterns. It's quite common that an economic unit is not necessarily the family, and the family definitions are quite broad. Just to pick on another example here, we talk about politically exposed persons and sort of how do we keep track of them. So one of the things with politically exposed persons is that the definitions of what that is in many of the high-risk jurisdictions must inherently be updated and differently defined, with the sole reason that it should really include kind of, again, this broader clan structure in some countries. In other countries, it should include an account for polygamy, so having multiple wives, multiple children from sort of different, the family structure is quite different. And yet, when we look at sort of our traditional politically exposed person definition, it's quite straightforward to include kind of a husband or wife and a potential sort of child and kind of immediate family members, and based on their visibility and position in terms of sort of a political celebrity status and so on. So adapting our basic concepts to incorporate and account for local knowledge is fundamental. And again, just to link it back to, and it's potentially profitable. Should we be kind of keen to walk that line of innovation?
So it sounds like then that gets to this little other part of our slide too, is what's the role of banks? We're talking about applying knowledge, local knowledge, and that, but then we're also talking about applying it to internal compliance measures, risk scoring models. You have utilizing big data here as well, which I know we're going to talk about a little bit later, but if you want to touch on that briefly to kind of tie that in.
Sure, yeah. So I'm also an ex-employee of a big global bank. And one of the things that, I remember kind of noting, and this is not by any means specific to the one bank that I work for, but really is relevant to many, many banks of larger global size, but also medium-sized banks, is that many of them are quite made up of mergers and acquisitions. And as such, they bring together data sources from a variety of different client databases once a merger and acquisition had taken place. So there's a lot of data and an influx of data coming into a particular bank that's kind of absorbing new business. And one of the things that, as an anti-money laundering person and compliance person, I was challenged to figure out how that data speaks to each other at quite the operational technical level. And what kind of trends could I read from that kind of data when in the first place those systems just don't speak to each other? So quite basically I would note that we need to be a bit better and stronger at making our data work for us in a way that's practically really promoting our work. We could be doing better at integrating the data in the first place. It will help us do transaction monitoring in a smarter way. Risk scoring models could be significantly more sophisticated rather than just focused on, for example, just kind of the two components of geographic location and, for example, source of funds. And the more sophisticated we are with our data, I think the better we can do with innovating lines of business that are applicable to high-risk jurisdictions. And even that term, what is a high-risk jurisdiction? I would break it down to go well beyond a country level, because even within a country, even within a city, you have different areas that could be accounted as not so high risk. And knowing to account for that, again, speaks back to this idea of local knowledge. But quite kind of, on the surface, banks could be doing better with making our data work for ourselves much, much better, and then reassessing kind of our risk scoring models and adding layers of sophistication to them, which requires thinking, a little bit of money, not too much, but it primarily requires buy-in from sort of senior leadership structures, and sometimes, a lot of different institutions may just be allergic to that kind of change. However, if it's linked to a profitability mechanism and to a social corporate responsibility structure, I think banks can certainly go a long way in impacting financial inclusion goals, for sure.
So let's talk about risk. I think this is a good segue. We've been talking about ways that we can bring people into the world of finance, giving them access, talking about human rights, profits, local knowledge. We're talking now about high-risk areas, and you mentioned the ways to mitigate risk or ways to figure out exactly how deep your risk goes in these areas. So we need then to really set that standard and say, what exactly is a high-risk area? And as we all know, FATF has said that, and many national governments have agreed and implemented the risk-based methodology and compliance. But there's a lot of dangers in this, or a lot of challenges in that you need to have, as we said, that local information, no matter where you're operating. That takes a lot of knowledge and a lot of data. You need to know your customers. You need to know your markets. So there's a lot of things that go into defining risk, let alone high-risk areas. So let's take a look at this slide and talk about the types of risk we're looking at when we're talking about high risk. If you just want to go down and start with regulatory. So what would make a high risk area?
So when we sort of talk about regulatory risk, I think here what I'm really trying to get at is that there's a few things that regulators immediately perceive as being risky. And again, going back to kind of, a specific list of countries or a specific list of industries that your customer base comes from, and looking, regulators will immediately kind of perceive that as being potentially a higher or a riskier client base. That's sort of one angle of it. regulatory risk, I think from a financial institution perspective, also comes to this idea that many of our decisions as a financial institution are driven by what we would foresee regulators would decipher as or interpret as risky. And therefore, we sort of calculate our openness to risk or our risk aversion based on potentially the regulator's response and let's say, our likelihood for receiving a fine, our likelihood for being sort of slapped on the wrist, our likelihood for receiving some sort of enforcement action, and that kind of essentially dictating how it is that we build our businesses and where it is that we invest. The regulatory risk, I think, has a few different angles, but at the end of the day, it impacts how we perceive risk and where we invest our resources around risk mitigation. Are we mitigating the risk because we don't want to get a fine? Are we mitigating the risk because regulators have communicated to us previously that they perceive our client base as being particularly higher risk? So there's a lot of sort of reflection that needs to be had around concern for regulatory risk. Countries that are economically developing also have multiple sectors that are looking for access to banking, many of which could be considered sort of medium, high-risk sectors. Specifically, when you talk about countries that are developing economically, you're seeing a lot of construction, you're seeing a real estate boom, you're seeing a lot of building materials kind of crossing borders, a lot of imports, and that sort of cash-intensive environment does tend to bring a lot of pressures into sort of our ability as financial institutions to know our customers. And that's,
I was saying in a lot of immigration as well, there's a lot of people movement happening there, not just cash that you have to keep track of.
Absolutely, yeah. So the cross-border element of it, think stuff, but definitely also think people and what they're bringing on their physical self, on their bodies. People often will bring in, will kind of translate their wealth in one country across the border and then sell that gem or sell that stone, and then good luck with chasing beneficial ownership of that money or those funds and kind of the source of funds. And then when people sort of deliver it to banks, then we see this sort of real challenge. Political factors, this could speak to a lot of the different issues around corruption, which are quite heavy and difficult to decipher, particularly with countries that are absolutely listed as being sort of high on corruption. Political factors also speak to the issues that we just sort of briefly touched on earlier around politically exposed people and the government officials who are driven by interests. Being on sort of this side of the world and Africa at the moment, we're looking towards a lot of heavy elections upcoming with a few elections behind us, and election season and banking and sort of tying it back to political factors, there's a whole lot of fundraising and a whole lot of cash that comes in from the Gulf, from a variety of different regions and countries, and trying to make sense of it all as a financial institution on the front line just pushes it towards a higher risk, less visibility zone and region, and that requires a higher appetite for risk, and it's really difficult to kind of decipher all that and work through it all. Nonetheless, we'll talk a little bit more about how we can do that later in other slides, but just to sort of give a flavor around the political factors, fundraising around election is a huge matter where, all of a sudden you've seen, for example, an engineer for his entire life who now all of a sudden can self-fund a political campaign and put on the line $500 million US. Well, that just doesn't work. That just makes no sense. And so you have to start making sure that your bank is protected against those instances. And you multiply that across multiple jurisdictions, and then it just becomes, you're in business for compliance. And I can see how that would really help banks step out of that environment rather than sort of step in. Conflict zones, post-conflict, economic reconstruction and recovery efforts. I mean, this sort of speaks to the same issues around economic development where beyond the kind of materials needed to rebuild and the construction issues and so on, you come across a lot of instability, political instability. There's a lot of looting still that goes on with particular jurisdictions. It's very difficult to assess when it's time to walk into, a previous market or a new market when you're unsure about the stability of that particular market. And that's something that, it's really important to make sure that inside a financial institution, there's a constant link between those who are assessing kind of pure economic risk and then those that are looking at the broader picture around the politics and the stabilization efforts and where money is coming in to put in the recovery efforts. The next bit here around it. Yeah, did you want to jump in with another point here?
Just wanted to comment on that. So war is very chaotic, and so it's very, very difficult because there's going to be lots of shifting of people. There's going to be lots of shifting of interests, and you're going to have situations, I would imagine, as well, where people are going to want to get their money out of those markets too because they're concerned about the risks and the safety of their own wealth. So that can cause a lot of confusion, I would also assume, with banks and maybe data systems as well, as we had talked about, understanding, what data you're actually getting out and what it actually means. So that would impact it as well.
Absolutely, definitely. And I would assume also that if you're seeing money deposited and withdrawn and deposited elsewhere and withdrawn, I mean, that might just go ahead and trigger a whole slew of scenarios in your system. And that's hardly, it's pretty difficult to begin analyzing those sort of transactions and in a timely manner.
So what about our regulatory pressures?
Sorry, I didn't hear you.
Sorry, what about our regulatory pressures that you have? You have regulatory, regional, and international as well.
That's right. So here we've got the sort of interplay between different regulatory systems that may not be in sync, may not be coordinated, and might even contradict each other. So you have international standards, you have national standards and legal systems and frameworks, and then you have sort of the standard operating procedures that are issued to you, along with kind of regions, for example, that have free flow of business and trade between them. All of those regulatory structures and supervision procedures, not only do you have to make sense of them all, so think, keeping on board just an army of lawyers to constantly decipher through all of these different legal structures and how they relate to each other and which one reigns and which one should be prioritized and so on. But if you're a bank that crosses multiple jurisdictions, Latin America, the Americas generally, and then sort of reaching out across Europe and so on, that's a whole lot of material to be on top of, including keeping up with sort of updates that are coming out on anti-money laundering and generally the regulatory systems. And so that amounts to a lot of pressures on banks who need to deliver and sort of remain aligned with the international standards, the domestic pressures, and the regional ones. And that's a fine line, and it takes a lot of work, and it's not something that you can sort of automate. And I've seen this firsthand where you could have sort of an easy transaction in front of you, but given sort of data restrictions in one country, the whole transaction just can't happen. And it's sort of a lot of regulatory pressures that intersect and then coincide, but also contradict each other. So that's something to stay on top of. But it's doable. Some institutions are doing this better and better. In terms of pure business risk, So
I wanted to comment on that. I think the thing is, too, is we also have to make a distinction when we're talking about regulatory pressures, and this is something that you alluded to, is that you obviously want to look at any money laundering and counterterrorist finance regulations, but you also want to make sure that regulations in other domains, which you had talked about, data, like in my own area, data protection and privacy, there's conflicts there too. So you're going to have jurisdictional conflicts among kind of the like versus like regulations, right? But then you're also going to have to worry about the other laws that may conflict with those. And so it takes an enormous amount of knowledge from a lot of different areas. I mean, we could add cybersecurity onto that as well. A lot of different areas for any bank or any company that operates in any jurisdiction, including high risk, to understand how all of these link together and may overlap so they can plan for them. But then also to have the staff internally to know those different areas can be really, really difficult because there are so many overlapping structures. So I just wanted to call that out too, is that we're not just talking about the AML regulatory pressures. There's a lot of interlinking regulations here that come into play, especially when you're talking about financial data.
That's absolutely spot on, and I couldn't agree more. And I think the complications seem to be sort of growing. You know, I would also throw in their sanctions and sanctions units and how it is that they would connect. You know, I've seen a few structures in which sanctions are kind of their own island, and yet their relevance to this conversation is absolutely principal. Likewise, internal bank financial intelligence units may sometimes be left out of this conversation, and those are all interlinked. Also within banks, I've noted that sometimes the financial inclusion unit or the mobile money or the mobile banking, all these sort of elements may not be really directly linked to this sort of compliance AML regulatory structure that all feed into how it is that we mitigate the risk. So I think, you know, we've kind of talked about a lot of these different examples here of risk, and I think the key sort of takeaway here is really around the number of stakeholders that you need involved in this conversation and the number of angles that you need to come at it to do high risk analysis well are you know, it's quite high, but it's doable. And you know, you've mentioned the data issues, again, the sanctions, FIUs, the AML teams, financial inclusion. There's a lot of partners involved in this. And so, absolutely. Mm-hmm.
So what about pure business risk? What do you mean by that?
So here, you know, one example that I've just recently come across is I'm working a lot with money transfer services, and they've really struggled with enforcing just basic know your customer due diligence measures, and it has direct impacts on their business. So the example that I'll give here is that if a person walks into a small money transfer service, so not one of the larger ones, which is really a smaller one, maybe it's in a grocery store, whatever it is, and they just simply want to send out $200, $300, the onus and the burden on the particular provider of the money transfer service is very similar to the same if that person would have walked in wanting to transfer a much higher amount. And that's causing a lot of people to shy away from using these traditionally, you know, quick, relatively anonymized services to just send over the $200, $300 back home or for whatever purpose they were using it. So now they have to, you know, show an ID, fill out form after form, and in cultures where that's not quite common to provide so much information, people are choosing to take their small business elsewhere, specifically maybe to those companies that are not registered properly or licensed properly, or who are willing to skip requesting that kind of identification and documentation. So in essence, there's a lot of pressure on businesses that are trying to do a good job of implementing all of the different regulations that they're placed on, that they're given, also because banks are requesting that from them in order to continue banking these businesses. And yet they're losing business because those clients who still want to send the $200 without showing an ID and their shoe size prefer to take their business elsewhere. So I've seen, you know, numerous companies kind of closing up shop and just being driven out of business, and then that just leads to a bit of a monopoly of the bigger corporations and the bigger money transfer services who can compete with that. And I think one of the most difficult situations in many countries that I'm seeing now is the request for an IP address. You know, sort of something identifying another linkage point to them and all they want to do is just send over $200. And that just culturally is really rubbing people the wrong way.
Right. So it's affecting. This is the lowest level, the consumer level, that it's affecting, and having that trickle up effect actually is closing businesses and unfortunately cutting them off. And this is where we go back again to finding ways to identify people through that local knowledge, because you're really talking about at the lowest level, the business serving the people. Exactly. So I want to move on to the results of these pressures in financial institutions. So there's a lot on this slide, but there's, I think, a few highlights that some of the things that we've talked about. We've talked about types of de-risking, I think touched upon the regulatory already. What about reputational, and what about risk mitigation?
Right. So generally when we're talking about kind of the results of all this, we just talked about how the easiest solution might just be to exit the relationships with those clients. If you perceive them as being high risk, why even bother? And reputational risk is something that I sort of see from two different directions. On the one hand, there's a reputational risk around being that particular bank or that particular financial institution that's doing business with high risk clients. If you keep them, you're the ones who will be given that extra scrutiny, and because you're sort of known to have a higher risk customer base. And on the other hand, if you start shedding those clients because you don't want to deal with that risk as a financial institution, then the reputational concern is that you're that bank that doesn't want to be financially inclusive and is solely sort of profit driven and so on. And so the reputational concerns are really, really tricky here, because it's really about crafting the narrative for your bank, and in sort of a free flow information environment and age that we're in. These things can very quickly become warped, and your bank could easily be associated with sort of high fines and a high risk client base and so on. So it's really quite important to think about how it is that we're shaping the narrative and the reputational concerns about how it is that we tend to do, who it is that we tend to do business, how we do business, and what kind of risk mitigation strategies we're putting in place, kind of based along our previous slide, and accounting for all those different issues.
So the way financial institutions can, I guess, mitigate this risk or try to mitigate this, as we have on the slide, forced to perform KYC compliance. So know your customer is very important. We have already talked about establishing trust, knowing who you're doing business with. That goes both ways, right? From the consumer to the financial institution. They have to trust the banks have to trust that they know who that they're dealing with. So talk about how KYC compliance, the impact of that for risk. Like we have there are financial costs, there's pressure. This is really not their business.
Right. So we see a lot of this conversation kind of shifting to, are banks really becoming a law enforcement agency? Are they really becoming our eyes and ears on the ground? And we'll see sort of financial intelligence units and so on forcing information from banks because they are presumably the front line. That was never something in the mandate of a bank to do. No bank has signed up to kind of be the guardian of the people. And nor does a bank have insight or the ability to really explain necessarily how individuals or corporations end up spending their money once either the money, for example, has been withdrawn to cash or so on. And yet banks are being held to that, to sort of do know your customer in quite a stringent manner, with more information being requested. And at the same time, a lot of pressure that's being put on the correspondent relationships with other banks, because now not you're, as a financial institution, based on your correspondent bank. And that's reaching to a point where banks are really pressured and correspondent banking relationships are being severed, because it's honestly easier to just cut the cord with a correspondent bank that you can't sort of 150% that customer base, and it just requires sort of the one bad apple or one bad client in your correspondent bank to come back in a reputational or fee or enforcement action against your own financial institution. So there's a lot of these pressures around the concept of know your customer and how to do them that are costing a whole lot in terms of investments around systems, third-party vetting systems, compliance structures, personnel hiring, and that adds up. And I think that, whereas once lines of business were sort of the driver's seat, now everything is kind of coupled with a compliance line, and the questions really come back to sort of, can we do this without risking the bank's reputation, without risking the bank against an enforcement action? And know your customer's customer is a concept that is simply too difficult and disastrous for a bank to even begin thinking about implementing.
Right. It takes a lot of labor and a lot of money, even as it's necessary. So we also have on this, and I want to get to the last slide, which really talks about, great, so how do we respond to this? But I also want to point out some of the sectors that are hit by de-risking. When banks pull out of these areas, who are they really affecting? I mean, we've talked about money transfer and remittance services, the difficulties that some people have using them, asking for additional information. Charities and nonprofit organizations we also touched upon, and saying that they're being affected because they're trying to get money into areas that have obviously many high risk factors associated with them. And the last two we really haven't talked about, especially embassies. And I think that this is very important because we have obviously people all over the world that are serving governments that are being affected. So if you want to expand on that a little bit.
Sure. So specifically for embassies, we see that they particularly are vulnerable in terms of providing politically exposed persons to a banking institution, which means that the bank immediately needs to sort of categorize them in a specific way. There's a lot of associations and links from sort of previous cases and years back around how it is that embassies are vulnerable to the laundering of the proceeds of corruption, embezzlement, state funds. So embassies come with a particular envelope of stereotypes and reputational concerns, as well as sort of practical, real threats that they would pose, particularly because banks might be concerned about a potential risk for a sanction violation. So these kinds of things, certainly banks need to be addressing embassies with a higher level of care than in other sort of sectors or in other type of industries. And there's a few different cases from the past few years where entire embassies were just unable to secure bank accounts, which meant they couldn't rent apartments, which meant they couldn't provide or secure basic utilities. And they're scrambling to find new banks who are willing to bank them. In fact, there's a great, well, it's not so great in a sense that it happened, but it's quite instructive where once banks sort of begin to shed foreign embassy accounts as a sort of a broad category of risk, there was a case of the Embassy of Angola in Washington, D.C., which was really the first country to really have all of its U.S. bank accounts closed entirely. And essentially, in response, the Angolan government threatened to close the bank accounts of all U.S. companies back in Angola, which included, Boeing, BP, Exxon, Chevron, a few of the really big corporations. And American business interests were quite clearly sort of being held hostage to this embassy crisis. And immediately this drew in sort of diplomatic, organizational stakeholders, because this was something that was quite a high stakes game. And at the time, there was a letter drafted to the American Bankers Association which sort of pressed businesses to resume business with foreign embassies, warning of the negative effects of account closures and so on. And in fact, it was only the intervention of the U.S. Treasury and the State Department officials who pushed banks to engage with embassies and to re-engage with the Angolan closed account that sort of brought this back to some sort of peaceful resolution. And that's just, an anecdote to demonstrate that not only is the embassy as a sector a problematic sector to bank, but can be banked. I think the broader issue here is the direct linkage to potentially sort of State Department foreign policy matters and interest groups that could lobby on behalf of and convey interests and really impact who it is that banks bank.
Yeah, absolutely, and that goes back and it speaks to access, right? Because if the embassies are really a country's window to another country, right, and that's where they can engage with local business leaders and local governmental leaders and talk about those issues and improve the relationship between two countries. This is when you think about the role of consulates, which actually take this really strong economic role in foreign countries. They need to be able to operate there to get those relationships. So it's an economic issue, but it's also a foreign policy issue. This is how we communicate. I think a lot of people forget that being, as much as we love technology, I mean, it's all around us, it's fantastic, you also need to have people on the ground to get those face-to-face communications. And this isn't just true in developing countries, but this is true in developing countries as well, like Western Europe. Having that face-to-face acknowledgement is extremely important for any relationships. So embassies play a very important role in establishing those and also being that conduit through which businesses can speak in foreign countries to potential clients. So these are the pressures and the results, I think, are really important. And we've already talked about the next slide, actually. We've touched upon various points in this conversation the impacts of wholesale derisking, loss of financial services, inability to move money. These small businesses lose money as well, and then you have these monopolies by larger corporations that may not always serve the best interests and also may mean that other companies, other banks won't be able to break into those markets as well. One of the things we didn't get through, however, is how this leads people to the informal and shadow economy, which is exactly what we don't want them to do, right? We want them to be open, transparent. We want those trusting relationships, but this can move them into the shadow economy.
That's exactly right. And what we see happening kind of day to day on the ground is that if I'm not able to move my money through the formal sector, I'm going to go do it through the other guys. And the other guys, we just don't have visibility into their transactions. So whereas once we were able to follow transactions, follow the money, see it crisscross the globe, we're setting up literally a structured setup for money to be moved out of our formal economy because of these pressures into creating this shadow economy and shooting ourselves in the foot because we had visibility to those accounts, we no longer see them, and we're losing a big anti-money laundering, counter-terrorist finance game in this because the money will be moved regardless. The question is, which system will it use? Right.
And so then let's get to the final part here and talk about what can we do. So FATF says we need to approach customers on a case-by-case basis. We have consistently talked about the need for local knowledge and understanding of these markets. If you want to talk about this expectation of financial institutions and what they can do, this has been, you and I have had discussions about this, and we've been talking about, okay, so there's things that banks can do to change in their internal processes about how they reassess their definitions of risk. And then also, there's very important, we talked about the role of technology. So if you could address the processes first.
Sure. So we talked a little bit about all those elements, and I think that financial institutions could certainly reassess their risk structures, risk models. We talked a little bit about the risk scoring. There are many sort of RegTech, regulatory technology solutions on the market right now that are aiming to give us a lot of the data management solutions that could help us do some of these hard concepts like know your customers differently. Before we sort of embrace a solution, knowing that there are many sort of vendors, for example, that will, take on board the data so that the bank doesn't have to do that, therefore sort of freeing them from any sort of obligations towards data protection and so on. There's a step before that banks could do and invest a little bit more in, which is the risk assessment. So our internal risk assessments, examining the methodology that we use to conduct our internal risk assessment, how do they connect to national risk assessments of countries, which is sort of the first recommendation in the FATF 40 global recommendations for good structures, and looking at how these specific high-risk countries, but also sectors that we talked about, the charities, the embassies, the money transfer services, what can we do in our risk scoring models and our risk assessment structures to better address those? And the second question would be, are there data limitations or opportunities that we could be exploiting, and is there potentially a technological solution that will help us do it better? And I think combining those conversations sequentially will really help us kind of begin to think about what are the opportunities within the higher risk countries for profitability and for sort of the common good and the financial inclusion components and the human rights components that we've talked about.
Yeah, absolutely. And I think the key to me, as I always think, is this: is traditional banks shouldn't do business here traditionally. There's really an opportunity here for innovation. It reminds me way back when in my academic years, I remember in 2005 lecturing to my students and talking to them about the impact of technology on the world. And at that time, there was this article about the Philippines and how people were using their phones to text kind of small transfers of money to people. And I remember my students were just shocked. Oh my goodness! This is amazing. Who would do that? Today we wouldn't blink an eye, right? We've adapted those things. But what's interesting, I always came out about that story was, as I told people, innovation is happening in a lot of these developing countries out of necessity, right? And because they don't have the kind of infrastructures, so they have to find another way to do it. It doesn't mean it's less profitable, it's just different. So I think traditional banks need to look at technology and how people have adapted that to solve really common everyday problems and things that we take for granted, like just having a bank account. You could do this very easily on a cellular phone. So technology is very important. And then you were talking also about the data management in terms of that technology, and that's where banks can do things on the back end, is understanding what the technology is telling them about their markets and about their customers.
That's right.
Yeah, so I think technology is the way to look at this. And you had also given me an example in our previous conversations about, practically speaking, within a financial institution, it's better for them to talk. So if you have the mobile banking group and then the compliance group need to talk, and that might be one way to bring them together.
That's right. And in one country that I work in, I've just seen this terrific example of private-public partnership where there was an opportunity for innovation. Innovation stepped in the form of people who sort of were quite visionary on this and found solutions to be inclusive of, for example, refugee banking. And in this case, for example, there was use of biometrics and specifically the iris, which, by the way, has the highest number of identifiers, close to 257 or so, which is very different from a fingerprint, which is only at 37. But in terms of sort of vetting and verification of identity, so there was a partnership between a biometric company, an iris biometric company, and the UNHCR, which is the Registry of Refugees, basically allowing refugees to collect their funds that they receive from the United Nations or from any other sort of source, and use ATMs across that entire country to pull their funds and to manage their money. And it was done against the iris, so all the ATMs in that particular country were equipped with a sort of a verification biometric iris scanner. And so now, basically, not only were the refugees given full access to their money in whichever ATM across the country, they didn't need to stand in long lines of, the refugee line, which has specific kind of connotations, stereotypes, and living quality of life ramifications. They could go to an ATM and begin building their financial portfolios, and also receiving funds in that way meant that they had to open up a bank account. And that's a promotion of an inclusive approach and creative problem solving that really sort of, it wasn't the long lines of refugees standing to collect their cash. This was a technological solution that promoted inclusivity and a formal banking system. And I think it's a great initiative, and I see a few of these examples, especially as technology, again, in this part of the world is leapfrogging everything way beyond credit cards and all this, much more towards the mobile money and mobile platforms. And there's a great opportunity to sort of jump into this market as long as we kind of are aware of the risks and remain quite local about our risk mitigation and understanding.
Absolutely. It's a simple, elegant solution, seemingly simple, elegant solution to a very complex problem. So let's go forward and wrap up. These are our key takeaways. Remember, financial inclusion is about access. This is something that we've been really hitting on very strongly to these open areas, to these areas that are developing. This isn't solely a financial matter. We hit upon embassies. This is important to foreign policy. It can be a security concern. It does promote stability as well, making sure that you cut off people maybe that are going to have the potential to go to terrorist networks or to just have economic collapse, political destabilization. Derisking represents a market failure. You have to understand the local compliance measures. We've talked repeatedly about understanding your customers. You'd have to treat these high-risk areas in the same way that you would treat any other market that you want to go into. And then lastly, I think fintech, data management and innovation is the way to move forward. These regulations have to keep up with the markets in terms of the technology regulations. And I think this is really important. Liat, what was our statement at the end? Don't exit, innovate?
Absolutely. Don't exit, innovate. You've got opportunities, embrace innovation, and if you need to convince the boardroom, if you need to convince senior leadership to innovate, certainly don't exit, innovate. That's the bottom line.
Absolutely. Well, I think that we are at the end of our time. I want to thank you very much for your insights. This has been a fantastic conversation. I hope that other people got as much of it out of it as I did. And thank you for everyone who joined us today. If you have any questions, feel free to contact us. We hope that this has been helpful. And thank you.
Thanks very much for having me. Thanks, everyone, for listening.
That does conclude today's conference. Thank you for your participation. You may now disconnect.